Reports claim Apple's Asian suppliers have already started mass production for the soon-to-be-introduced mini iPad. September PMIs for the services sector across Europe were weak, but Spain remains the major concern. I'm Lindsay Bell, and the Morning Call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsay Bell with The Street, and together we bring you the Morning Call. This morning we got PMI numbers out of China, out of Europe. Everything looks weaker. That's exactly why we've got the central banks doing what they're doing out there with more easing. But the futures are looking quiet so far, Scott.
Well, I think markets are just still in wait-and-see mode. What's going to happen next? We've had a huge move this year. Can it continue? Do we need to, correct a bit further? So I think a lot of traders are just doing a little less as we measure, the price action and levels in the S&P and the overall sectors to figure out, do we put more money to work here, or can we see potentially some lower prices first?
Now, looking at the chart, you mentioned a little bit of a concern looking at last year, the price action. So what is that saying for this year?
I like to look at chart patterns and see what happened at certain time periods just to be prepared if then something transpires this year. So I've shown you the macro pattern here on the S&P many times, starting from about a year ago and how you could have maneuvered it. So I'm just looking at one pattern within this overall scheme to figure out whether or not we correct a little bit more or continue higher first. If you take a quick look at the chart here, you will see this is when we bottomed out in October of last year. That's about a year ago. From there, boom, big move, 300 handles. But in this chart pattern, you had a quick move up to about 1,300, and then right here it looked as if it was going to wedge. It looked as if it was going to break higher going into December, and it would resolve to the downside. But have no fear, after resolving to the downside, it still held all retracement rules, built a bigger wedge, and then the move didn't come in December. It came in the first quarter of this year, and that's when you had a nice move up to almost 1,400. So now here we are since the June 4th lows. It's been a really nice move. If we take a closer look here, you will see you have two trends. One that aligns with the 50-day around 14.15, and this accelerated one that started in late July that's testing right here. So I'm trying to figure out whether we hold this 14.30, 14.35 area, or do we see a discount to retest the 50-day and get a better entry right there. And as of right now, we're digesting well. I think things are acting okay, but there are some faulty signals, so it's no need to be all in right now.
Okay, good to know. In the sector spotlight, we're going to take a look at some of the consumer discretionary names. Why don't we look at the ETF first, though, the XLY?
Yes, XLY, good proxy. We'll take a quick look. I want to see if there's any relative strength here or if it's just in line. If you look here, it's had a nice move. This is where it broke out from. Tried to hold up here. This is when momentum left the XLY. It broke this upper area. It's now hovering below like most other things. I would say right here at 46.49, if it starts breaking this area, this can see a move to the 50-day. So I think this is in wait-and-see mode as well.
Looking at some of the stocks within the sector, we'll start with PetSmart. This stock got added to the S&P 500 yesterday. It's up 34% for the year so far, has had a pretty good run. But I think they've got secular tailwinds behind them. People are owning more pets, and they're willing to take care of them, buy them food, supplies, treats, people just love it. But from a trading standpoint, what's the stock look like to you?
Well, most people take care of their pets like their kids, so that makes sense. So if you look at the chart real quickly, you'll see that it is holding a trend line. I think it's holding at this point. If you're like a dip buyer and you want to be in a tier one, be in tier one versus the low here of about 66, 68. But for traders to get excited with it or to get to a tier two, it's going to have to start clearing the 70 area. So for right now, it's in the game. It's holding the moving averages above the 200. I don't think it's anything exciting, but consumer staples rarely are.
Express yesterday was down 22%. This is a retailer that they announced that they were going to miss third quarter earnings on weaker sales in September. They were promoting, but the promotions weren't working, so inventory isn't in great shape. It just seems like a mess. So I don't know. The stock's down 22%. Is the damage going to be contained here?
Well, if you take a look at the chart, you will see that the last time it gapped down like this, it never filled it. So that showed you the weakness. A gap down from 22 all the way down to 18, came back up. You draw your line here, and this shows you that this professional gap controlled the direction. So here you are again, a big channel, boom, gap down again. I think it needs time. At this point, traders will probably use a low here of just say 1156. If it does some kind of reversal here, but at this point, another big gap. Last time I didn't fill it. This time we'll see if people think it's on sale here. If this gap doesn't get filled like the last one, it could still see lower prices, but it's worth watching.
Bed Bath & Beyond is one way that Stephanie Link and Jim Cramer are playing the housing recovery here. It's a derivative of that. They reported earnings about 2 weeks ago. The stock got hit, was down about 9%. A lot of the issue there was their acquisition of Cost Plus, which is pressuring margins. Now, I think after another few quarters, that margin issue should be addressed and they should be able to get through that. So Stephanie Link likes that the expectations have been lowered. The multiple is lower than their peers. She likes it from a macro perspective.
She likes macro fundamentals. She likes to buy things in the whole, a little bit of a different style. So that makes sense if you have that timing. If you look at the chart, though, to me, it's telling me a different story. If you look at the last time it gapped down huge, it took about a month and a half, but then it wound up being an opportunity for traders to fill the gap. So here we are again, another gap down. Is it going to be forgiven? I'm not so sure. I think traders will be watching this area. At this point, it's not showing that it's cheap, that people are buying it on sale. I do think some might actually try and short this if it breaks below 61.70. So if it breaks below 61.70, if you're not committed to it, get out. I do think that you have an area of support lower here. If you want to even go a little bit further back and look at the chart here, this is a pretty big area, but the 60 is much more major. And at this point, if this gap doesn't get filled like last time, I would think it's an avoid. And you just have to wait. And if you want to do it for a fundamental play, put a little bit in, to hold on the dip and then wait for the stock to show you something before you add it all.
Okay, gotcha. PVH, this is a stock. These guys make the Tommy Hilfiger and Calvin Klein brands. They raised guidance yesterday for the third quarter and the full year. They've got exposure in Europe, and what's nice is they're transcending the problems that are there. The stock has been consolidating, though, for a little while. What's it going to take to break to a new high?
Well, this one technically is telling you a different story. It's acting higher. It's at the higher end of the range. It's above a lot of the moving averages. You look at the chart here, you'll see, this was a spot when it cleared this channel to get involved above 82, had a nice move, and then gapped up. We talked about gaps. Well, this one is holding it to the upside. I think you could stay committed as long as it holds this gap. The gap here is around 91. For it to get any type of momentum, I think we need a better market. And if we get a better market, this is in the game to start breaking above 95 for some momentum.
We're going to take a quick commercial break, and when we come back, Nicole Erkin is going to take us into the trenches.
Hi, I'm Scott Redler, Chief Strategic Officer for T3 Live, and I would like to invite you to join us on October 6th and 7th in New York City for our first annual T3 Live Active Trader Super Conference. The two-day event will focus on what we believe to be the 5 keys to being a successful trader. We will teach you the strategies, tactics, and mindset we take to the market every single day, and you will leave the Super Conference with a personal step-by-step success blueprint. Visit t3live.com and click on the education tab on the top of the page and watch preview videos of this event. Seats will fill up quickly, so be sure to reserve yours today. My colleagues and I look forward to meeting you. Have a great day. Welcome back in the trenches with Nicole Erkin, who's going to go over some opportunities based on China and about what could happen if the slowdown actually stops slowing down, which we haven't seen yet, but it's probably getting close to that point. So here we have Nicole, and Nicole's going to give us some color and some value on some of these names we don't ordinarily talk about.
Yeah, good morning. As we continue to move into the fourth quarter, the very starts, we're continuing to weigh what's happening in the U.S., in Europe, and China continues to remain an important lever. As you mentioned earlier, we got weak data out of China this morning, but what we continue to see is opportunity for easing to come to play. We don't have 0% interest rates there like we do in the U.S. We have a new Congress coming in. We've seen action by the government. And I think that if we do see a little bit of action here, some of the China derivative plays have some opportunity going into the rest of the quarter. So let's take a look at some of those. We wanted to start with CAT, which obviously started a lot of murmurs in the whole China spectrum after their downside guidance pointing to 2015. Based on its sell-off from the mid-90s to the mid-80s, what are you looking at here?
Well, it's been a weak spot all year, and it gave you many ways to get out of it. So if you did get out of Caterpillar, there are ways when you get mega blue chip companies like this, when it's down on the cheap, in order to find an entry. So I do agree that there will be opportunity in CAT, especially if you sold it correctly. If you look at the chart here at Caterpillar, you will see, if you remember this ascending channel that broke to the downside, that was one way out, but then it came back up and retested, couldn't claim it, so that was your sell right there. And if you didn't sell there, you had the opportunity once it broke this major support, around the 200 day at 100. So there are a lot of different ways to get out of Caterpillar if you actively manage your positions. And now coming into where we are here, this, in the whole, it could be a tier 1. Yesterday, it reversed. You have a little bit of this broke below, came back above. It's below all the moving averages. It has a lot of work to do. Every time, it's rallied up, sold, rallied up, sold. It is following a small little trend here, which I think you could trade verse, and it's better just to be buying this on the dip versus adding on momentum, because that hasn't worked yet. I think people want more clarity in China as of now. It's a decent tier 1, and at some point down the road, if it starts acting better, you get back involved. If you, again, sold it up here around 115 or sold it when it broke 100, you have the opportunity and the luxury of retesting it down here around 85.
I think that's a great point that you mentioned, that it's really been weak all year, because the news that we got out last week or the week before, it wasn't anything new. We know that they're slowing. We know that there are some issues there, and actually their guidance guide down was for 2015,
right,
which shows some of the issues with having a 5-year plan or a long-term guidance picture when we don't really know the full story. So we do need to wait for some more clarity there.
And when you don't know the full story, you wait for the price action to show you the full story. And the price action will tell you when it's priced in. And as of now, it doesn't seem like it's priced in, but it doesn't seem at this point, it looks like it found some support. So, tier 1, and we'll wait to see on the next one.
Moving on, when we think about China,
here you go.
Technical issues. I'll just talk into this for a second. When we look at China, we have the industrial names, but we also look at the retail-related names. And in that spectrum,
there you go.
There we go.
Nice.
2 of the casino stocks that are very levered to Macau are Las Vegas Sands and Wynn. We know that they are VIP plays about growing middle class, more spending power. What do you think of these here?
Well, now you're kind of speaking my language, because this is what we trade. These are very active, and we've had a nice move off the lows. So like you look, trying to find a low in Caterpillar, we found one way back when in LVS. If you take a quick look at the chart of LVS, if you remember, we tweeted about it. Remember last quarter, remember there were 2 ways to trade LVS. Here is where I put its top in. Okay, and then finally on the numbers that were horrendous, it came in and it did a reversal right there. So we tweeted about it. I said that day, I'm like, it looks like LVS capitulated. If you come in here and look at your basic studies, just so I could show you the volume, because the volume that day was insane. You go here, boom, look at the volume there on LVS. Nicole, I want to show you something technically. Look right there. At a bottom, huge volume. That means it could have changed direction. Then you had a quick move, and it's been flagging all the way higher. At this point, it's consolidating again. I know for us, we have it on our radar. I think it could stay tier 1, but in order for it to get momentum, it's got to trade above 47.20. And if you take a quick look at Wynn also has been consolidating and tried to push out right over there. It couldn't. Still above the 8 and 21 day. This was a nice trade. I think at this point, I'm in wait and see mode. I'm not holding it, but if it starts to get above, 116 and change, I think you're going to get some momentum there. So right now, the casinos are back in the game after what was a pretty big pullback that started in May and June.
Right, and it's all about comps. I guess everyone knew we had such strong growth in Macau. Now it's, well, can they maintain that strong growth? And I think when you pointed to that bottoming, all of the growth, but maybe at a slightly slower rate, expectations were priced in. And we have, hopefully Sheldon Adelson, after the election's done, he's been contributing a lot to the campaign, so maybe some of those headlines will get out of the picture.
Right.
But moving on, I guess if the VIPs want to grab some KFC after their big wins, we'll move to
because that's what they go
brands.
after. They don't go to the steak restaurants.
Right, exactly. But Yum Brands, we think of as KFC, Taco Bell, Pizza Hut. We know it very well here in the U.S., but it's really a China play. I think about 40% of its profits are from China, 30% additional from other international plays. It's a big high beta, or high beta also, but also high multiple stock. It had a little bit of weakness over China worries. What are you looking at here in terms of levels?
In terms of levels, I was looking at it before. It doesn't look like it's ready to go, but it's something that if you have multiple positions and you're looking for China to rebound, because I was into China and they love their KFC, they love their taco, they love all that, and I do from time to time, but maybe once or twice a year only. It doesn't help with my Ironman training. But anyway, you look at the chart here and you'll see that it's above the 200-day, it's hanging around. I don't see anything so super duper exciting. It's worth a tier 1. At some particular point, if it starts acting a little bit better, it could start trading above 68 or it could start trading above 69. This is something that's just going to take some time. It's not exciting, so you have to have a good entry. And I do think with time, a stock like this, a value type play could make a move, especially if some of the stimulus starts coming into play and China starts bouncing back. And at this point, I would trade it versus the 50-day. If it starts breaking the 50-day, though, be prepared that, the 200-day is what it's been holding. So right now it's in the middle of this range. So I would keep it small for a trade. Guys are probably not really putting it on their radar yet.
Well, I guess we should move away from KFC since it's pre-8 a.m. I guess we don't want any stomachs to turn. But when we're thinking about China, there are so many different ways that we can think about it, so many different plays. Yahoo is not a name you would think about when it comes to China. But we actually just looked at Yahoo on Mad Money earlier this week because finally with Marissa Mayer at the helm, she just had a baby boy yesterday.
Congrats to her.
Yes, or I guess it was the day before. We now have this sum of the parts story that actually could come to fruition. This is an argument that's been made multiple times, but now with someone new, an actual action plan, the first half of the Alibaba 40% stake now closed. There might be some momentum here. This stock has really flatlined ever since the recession. So do you think it could break out?
Well, I've looked at this chart a lot of times in the past year because I love long consolidations, because typically when you have a long consolidation, that means that shares are changing hands, institutions are getting involved, someone's there positioning for something. That's why this year I loved Walmart after its 9-decade move, of consolidation. That's why we talked about Google also consolidating for 4 or 5 years. So if you look at the chart of Yahoo right here, look at the size of this consolidation. All right, so if you were not caught in this for the past, 2 years, you saved yourself a lot of pain. But there is a nice consolidation. And if you guys remember when this thing was, supposed to get taken over right around here, in the 30s, and they said it wasn't good enough? Well, somebody was willing to pay for it then, in the 30s or somewhere around here, wherever that was, so at this point there is locked up value, but the question is, when does it happen? At this point, I think the chart is looking better, and I think that, it's starting to hold higher within this channel. So I do think that traders will be looking for a breakout of some sort, and that comes in above 16. So above 16, I think traders will get in there and maybe try and stay with it. And it'd be nice to see Yahoo break out to the upside, because overall for 2 years it's done absolutely nothing.
So moving from a name that hasn't really moved around at all to a group that has, the fertilizers. Mosaic, we had the CEO on the show yesterday. They had a disappointing quarter. What are you looking at here? They were just downgraded by Lazard this morning.
I think that sometimes they give a pass to these fertilizer companies because typically they don't announce good earnings, but they reverse. Right. So yesterday we talked about, will they buy the soft earnings, and they didn't. So it became an avoid. Mosaic gave you a nice entry with this red dog reversal that we talked about way back when, right here. Okay, it had a move, and now at this particular point, it's below the 200-day. It's below this digestion or congestion here. For my traders are going to be avoiding it. I think next support, you could look at a point of reference right here, and then another one, maybe down into this 52 area. But at this particular point, once it broke this upper range, anyone who was hoping for higher prices before earnings, got out of the way, and then those that don't take it into earnings, it's not their problem. But for this particular point, I think the stock's somewhat broken, and it's going to need time.
And important to mention, this is a China play because we have the rising middle class in China along with India and Brazil. This is a long-term secular theme, more need for food, right, limited land supply. This is, again, the trade-off between some short-term earnings variability and maybe a longer-term secular theme that we continue to look at on Mad Money, for example.
Yeah, and it's all about the time frame. It's all about how active. Not everyone
right.
is so active like we are over here. So we like to look for, when both worlds collide, and for right now, Mosaic, the worlds collided back at that low, and then if you go back to the chart one more time, the worlds collided technically when it broke above this resistance, and then it started acting really well, and then the worlds kind of detached right here when it broke this level, and then we don't take it into earnings, and then yesterday it was worth a look, and it didn't react very well. So at this point, I think if you did sell it well into strength, look to maybe buy it back when you see a reversal type pattern somewhere between 52 and 54.
And lastly, we can't talk about China without the retail levered plays. A name that disappointed largely because of their China futures was Nike recently. Other China levered names are Coach, VF Corp. All of these names have a low percentage of their sales levered to China, but it's the highest area of growth for their within their segments. What are you looking at here? Are there any opportunities?
Well, the high end got really beat up, and then they had moves off the lows. And
right.
I think one thing that we talked about was Coach.
Right.
Okay, and Coach right now it's kind of interesting. It's not compelling, but it's interesting. You look at the chart here. This is when it did its little red dog reversal, made a new low, came back up, rallied, showed commitment, gave you a move, and then it lost its momentum right there. That's when traders probably said, you know what, the moving coach is probably done. Came back down, starting to wedge here. I think if you want to be in as an investor, trade it versus the low here of 53.15, and in order for this to get back in motion, it's going to have to start getting above 57. So you had a nice move off the lows here, nice commitment there. Here is the trade. Here is where you had to leave, and now it's into this little wedge type pattern where you need to see which way it resolves. So I think there's something to watch there for a trade and as an investment. You have to really love the name, which I don't have that much commitment to.
Yeah, and Jim Cramer on Mad Money, we always talk about management. Lou Frankfurt has been a really incredible manager of Coach. People are worried about competition with Kors and the aspirational luxury brand. I've talked about that with Lindsay Bell. So interesting here, longer term. Nike in the low 90s. Stephanie Link sold for AA+, but it's come off. Again, it's all about what's priced in and what isn't. So again, entry points are always important to think about.
Yes, and with Nike, we'll take a quick look before we go into quick hits, and you will see that Nike again has been a problem spot all year. You had your breakout failure right here. Okay, came in, and then this is when it broke support. Look at the potency of this break right here, hovered below, and then since then gapped down, and that was priced in. It's churned all the way up, and at this point, I still don't see anything great here. It's below the moving averages. It's okay, so. Right now, I would think that if you're in it, play it versus area. But again, this is more of a fundamental story. If that's what you're looking for a trade, I don't think guys are going to be looking at it.
All right, so let's wrap this up quickly with some quick hits. First off, Core Labs, CLB, disappointing guidance, technology play, oil service. What do you think? I
think it's just an avoid. Use yesterday's low as a pivot. Big gap down. Nobody looked to buy it yesterday. Avoid.
Next up, PCS, more takeover talks. This seems to be endless. We've looked at Sprint as a spec on Mad Money. What do you think for PCS?
I think if you're trading it on pure speculation of a takeover, they usually never happen. If you look at the chart here, though, someone believes in it. And if you look here, it gapped up right there. So technically this, was your spot where it had a lot of momentum. Then it continued. And then yesterday, it squeezed again. I would not be chasing PCS up here, but it does look like there's a lot of money behind this, as if there could be some truth, to this story overall.
And lastly, we can't finish without looking at Apple. After some early morning weakness, it faded until the last hour of trade. What are you looking at here for the remainder of the week?
Well, we talk about Mad Money and we talk about strategy. And I think it was a week ago, we went on and said if it breaks the 21-day moving average, that traders will say the momentum has left. We'll tread lightly and we'll go two ways, both long and short. And if it breaks that 681 to 683, we could see the 50-day. So why sit in it? I know investors like to sit, and the highs of the year most likely aren't in, but we could trade, and that goes with your time frame analysis. So yesterday, if you came in and you look at Apple, you will see that Apple did, after breaking the 21-day right there. I know I got stopped out of my Apple right there at 683. You had the luxury of trying to rebuy on the 50-day. 50-day was right there. It held above, this prior breakout, which we also talked about, which was 644. So if you go back and look here at Apple, you will see that, as of now, it was a good trade. Okay, good trade, made $10, $12 yesterday. Now the question is, can it reclaim both these moving averages, and get going again? So some guys who did it as an active trade will probably, they took it off yesterday. Some was a swing. It's up $3 pre-market on the iPad, talk. And then, if you're an investor and you sold here, you saved yourself 30 points. But, it's definitely not sure that this is the low here. Okay, but at this point, it was a good plan. Now, in order for this to get out of the troublesome way, I would say it's got to start getting above 676 and hold above it and show commitment. And if all of a sudden it gives back half of what yesterday was, there's going to be some concern that it could go lower than the 50-day. But for right now, I think it's in play. I'm still long it. Great tactical play, and hopefully yesterday was that low.
Well, Apple never fails to be exciting, so good to end on that note. Thank you again for having me. It's really a pleasure to join, and happy trading. Thanks for joining the morning call. That's what we have.
Yes, and if you want, join us on the recap. We'll go over what worked, what didn't, and go over potential looks for tomorrow. Have a great day trading.